Okay. Hi, everyone. Welcome back. I'm Josh, the Teen Services Librarian at the Pontiac Public Library, and I have Colleen Godfrey with me again from the Michigan School and Government Credit Union. Today, she's going to be talking about building and boosting credit, probably using loans, as you can see from the slide here. So, whenever you're ready, take it away, Colleen.
Right. Thank you so much, Josh. Yes, tonight is loan basics. And like many of the other personal finance things I talk about, I think it's important to learn about loans before you get them or have an idea of the terminology of what you might be in for before you even start looking for your first loan. But it's never too late to add to it. Loans are the gatekeepers to some of our biggest goals. It's thought of, oh, debt. You know, anytime you owe money, it's debt. Debt is bad. All debt is bad. Not necessarily all debt is bad. You know, you need help sometimes to cover purchases, you know, a home, an education, going to college for years and years and years, you know, medical school after that. Well, that's an investment in yourself. So you're borrowing money. But because of that, you are now worth more. You have the ability to earn more money. You know, I'm borrowing a lot of money for this house and I'm going to pay on it for years and years and years. But once I pay it off, I own it. And now I have something, an asset that's worth something. So there's many reasons to have debt. It can be for a silly, irresponsible reason, or it can be for a very responsible reason. A small business loan. You want to buy equipment to start a landscaping company, or you want to buy, you know, a plot, a small building. Things like auto loans and personal loans, that auto loans is, again, just your car. Your car will depreciate in value over time. So that would usually be considered, you know, kind of a bad debt. And personal loans, it depends. So loan terminology, what do you need to know? What should you have in mind? The principal, when you hear the word principal, really they're talking about what you owe. You know, when you get to the register and they say that, you know, the total is $15.50. That's the principal. What is the total amount that you owe, the amount that you're going to borrow on the loan? It could be $5,000 because, again, maybe you're just taking a loan to fix up the kitchen and get, you know, some new kitchen appliances. Or maybe you're borrowing $50,000 for a business or $500,000 for a house. But that, starting out, that's your principal. The interest is what you hear so much, that everyone's so concerned about. When you borrow money, the idea is you will pay it back, but over a length of time. You know, you have the luxury of time. It's not, can I borrow it today and I'll return it next week? I mean, you certainly may have that situation, but for bank loans and credit union loans, they're set for years. So because they have to wait years to get the money back, because they can't do anything with it in the meantime, because you're taking advantage of the fact that you are not paying it, you know, completely back, you're being charged interest. So it's fair. Interest is saying you're going to have to give me a little bit extra on top of what you owe, on top of the principal. So when you hear interest, APR is the same thing. When you hear it's the APR is 15% or is the interest 15%, they're referring to the same thing. That number is how much extra you're paying, right? So if it's $5,000, you could have a 4% APR, a 10% APR. The 4% would be much better because the higher the rate, the higher the number, the more extra money you're paying back. And the term is also important. The term is how long you have to pay it back. And that definitely matters. Certainly if it's a very, very large amount of money and you need many years, especially a house, you may need 30 years to pay it back. But on the other hand, if you're borrowing $10,000 for a car, they're definitely not going to let you pay it back over 30 years. I mean, they'd say maybe 7 years at the absolute longest. And your payment, how much you pay each month towards the debt, whether it's 48 months or 60 months or 72 months, that changes your total payment, and it changes the total amount of interest you pay. So all of this is relatively negotiable. What's the total amount I'm going to borrow? What's the interest rate that I'm going to have? And what's the length of time that I'm going to take to pay the loan back? Any loan can really be put into the category of secured or unsecured. It's just a way to designate, it's just a separation. Loans can be either secured or unsecured based on whether they're protected by collateral. Secured loans have collateral. So of course, then your next question is, well, what is collateral? Collateral is something of value that can be taken upon defaulting on payment. You've heard of a vehicle repossession. If I borrow $10,000 from the credit union and I sign the paperwork that says please pay the dealership because I'm going to take this car, and I promise to pay you $250 a month for the next 6 years. I'd have to work out the math. That's my responsibility. I signed a contract, so I have to pay $250 a month, even if I lose my job, even if times get rough, even if I get sick and I have to miss work for a bunch of times. I'm still responsible for paying my bills. So if I do not pay my bill, maybe I miss 2-3 months, sometimes as early as 1 month, the lender, the one who is waiting for my money, is going to say, well, I'm going to take something else. You know what? I can't wait for my money. The deal was you pay me, so I'm going to take back my car, the car that they purchased with their money. Similarly, on a house, if you stop making payments on a house, or you get really behind on your payments for your house, the bank may say, we're going to take your house. We're going to foreclose on your house because that is more valuable. We're losing money. And it's really sad, and it can do a lot of damage to your reputation, to your mental state. So if you are taking on a collateral loan where, the boat can be taken away, the motorcycle, RV, really make sure you understand what you're signing and that you feel you will absolutely be able to make payments and you have some savings so that it's not taken away from you, so that you don't have that reputation of not being able to pay your bills. And the worst part is they don't give you the money back that you already paid into it, because that was also part of the contract. So you lose your car and you lose the money that you put into it. So that's no fun at all. Well, why would someone even want a secured loan then? A secured loan requires collateral. There's a lot of items that are pretty expensive items, a car, a vehicle, there's a tangible item. That's the collateral for the auto loan. The boat, the motorcycle, the house, that's the physical item that is being purchased and can be, taken back. So you don't have a choice on your home loan being secured or not. That's just your home loan is. But because they have an item, because there's collateral that can be recouped, they have much lower interest rates because there's less risk. Even if the borrower doesn't pay, I can get the house back. Even if the borrower is really behind, I can take the car back. So it's less risky. I don't mind if they take a longer time, because I'm pretty sure that they're not going to want to give up their car. They're not going to want to give it up. So they're much more likely to pay their bill. And I'm going to get the item, and I can sell that car and get the money, or I'll sell that house and get the money, because in the end, That's really what's wanted, right? Is just the money. An unsecured loan has no collateral. So what would that example be? I need a student loan. I need to borrow $50,000 to pay for school. I need a $20,000 loan to pay for my daughter's wedding. Those are, for a family vacation, to take my whole family on a trip to Italy. Those are things that someone can take out a loan for. Those are expensive things that you certainly might need a loan for. But what happens if you don't pay your student loans back? What happens if you don't pay the loan that was for the wedding back? I mean, the bank can't take away your education. They can't take away your marriage, right? There's no physical, tangible object attached to the loan. It's really based on trust. Therefore, it will have much higher interest. It will be more expensive to get. It will be harder to get. You will have to pay it back in a shorter amount of time. And that makes sense, right? There's more risk to it. If I have just enough money to pay one bill, well, personally, I'll probably pay the secured loan bill because I don't want to lose the car or the item that goes along with it. I'm sure as young people, you've had a situation with your parents where it was, oh, I need to borrow money for this plane ticket. I need to borrow money for this prom ticket. Please, you got to let me borrow it. And they say something like, well, sure, I'll hold on to your Xbox. I'm going to keep the Xbox in the bedroom here. And then as soon as I get my $100 for the prom ticket back, you're more than happy to have your Xbox. So now you're like, oh, now I really have to pay him back. I actually do have to pay him back. And you're more invested in paying him back because you want your Xbox back. And he knows that. So it's just whether there's a tangible item attached to the loan or not. And if you're trying to get a loan for just money, I just need $20,000 to buy a bunch of clothes. That's not a good idea. But if someone wanted to do that, it would be very expensive. And they might say, I could turn it into a secured loan. So I've already paid off my car. What if I write into the contract, even though I'm borrowing $10,000 and I plan to use it on buying clothes, I promise that you can take my car if I don't pay it back. It's all written in very detailed language. Then it becomes a secured loan. Now there actually is something tied to it. So then I can get a nice lower interest rate. But if I already am paying on my car, I can't have two loans on it. Just keep in mind what you're getting the loan for. That certainly matters, where you should look, how expensive it's going to be for you. So think safe and secure. A secure loan is safer for the lender. It's safer because they're going to get some of their money back for sure. Only borrow what you need. Absolutely. And this goes for anything. Please don't borrow $20,000 to buy clothes. That would not be a great idea. If you need money for school, I understand, but just borrow what you need. If you want to borrow money to pay for a wedding or to take your family on vacation, I understand. But don't borrow for the sake of borrowing because someone offered it to you. Don't say, yeah, I would love to take a $20,000 loan. You know what I could do with $20,000? Yeah, I'm sure we have lots of ideas. Do you need it? Why are you taking out the loan? Because you're going to be paying interest. It's going to be costing you more, much more, than the original $20,000 that you're getting. The larger the loan is, the more interest you'll have to pay back in the end. Your credit score. We talked about credit cards last week. Credit cards are one example of a type of credit where you pay the bill, you make a purchase, you get a bill, you pay it off, and they report to your credit report, yep, on-time current payment in full. And then the next month, you pay it in full, and you pay it in full, and you get this kind of adult report card called a credit report that shows your financial behavior? Is it responsible? Do you pay on time every month? Do you pay late? Do you only pay the minimum balance? Do you have a previous, repossession? Do you have 5 different credit cards? It's like a report card of your different credit. Only your credit, which is buy now, pay later. Things like your checking account is not on it. Things like your savings account, your income are not on your credit report. Rent is not on your credit report. Your parking ticket is not on your credit report. Think, is it something that I'm getting now, but I'm paying for later? Okay, well, then it might be credit. So what do you want? You want it to say the best possible, right? Of course, we want our report cards. We want all the material about ourselves to say wonderful things. We want it to show us as reliable, as responsible, meaning we'll get a much lower rate. The more responsible we appear, the more responsible we have acted in the past, the more likely we appear to be responsible in the future. And lenders like to get involved with responsible people. They like to get involved with borrowers who they are confident will pay them back, that they're not going to have to, bother and send a second and third notice and call and say, we're going to come take your car if you don't give us this money. Just, I'll give you the money, you pay it back, and everybody's happy. So your behavior does matter. Whether you pay your credit card late doesn't just affect your credit card. It affects, how you are seen overall. On your credit report, what is it that lenders look for? I mentioned on-time payments, reliability. Reliability is great. Responsibility makes someone predictable. They like predictability. A solid employment history. Solid employment is not necessarily going to be on your credit report because it's not about what job you have. It's whether you pay your bills back. But if you go in and say, well, I've just got this job 6 months ago and I'm really excited about it, and I'd like to borrow $50,000 to get a new car to celebrate, well, it's still a brand new job. That kind of makes me a little nervous. But if you came in saying, oh, I'm celebrating my 10th anniversary at my company, and I wanted to get a $50,000 car to celebrate. Well, just with those 2 statements alone, I feel a little more reliability, a little more comfort with the person who's been with their company 10 years, right? That's all it tells me. But it gives a sense of, some solid history. So keep that in mind. Don't apply for loans all at the same time. Don't apply for a new job and a new loan at the same time. Look at what debt you have. They are going to be looking at what debt you have. So you should look ahead of time. Is there some credit cards you need to pay down? Is there is there anything out there, a magazine subscription that you forgot that you had, that you didn't know you've been charged for? You need to start looking at your finances. You need to look at how much you're taking in versus how much you're paying in expenses. Because credit is meant as a safety net so you can keep going. It's not meant so you can just endlessly keep going and endlessly keep spending. A cosigner is an option. What a cosigner is a second person, could potentially be a third person, that takes on the loan. So if I were buying a car with my name, it'd be Colleen Godfrey is responsible. Colleen Godfrey gets the mail, she gets the bills, she's the one that would get taken to court. But let's say when I applied for the loan, I really didn't have very good credit, and I was young, and I didn't really understand, so I wasn't doing it very well, and I couldn't find any good deal. So I asked my parent, let's say my dad, to co-sign. Dad, if you put your name on it, you're much older than me, you've got great credit. If your name is attached to it with mine, it makes it look, much more responsible. So they'll give me a much lower interest rate. I'll get approved. Sounds easy, right? He should be like, of course, why not? Well, because that means he is also responsible for the loan. I can say, don't worry, I'll pay. The bills are going to come to me. I'll make all the payments. You don't have to worry about a thing. I just need your name. Well, what if I don't pay? What if I intend on paying every month, but we get into a big fight and I say, well, I'm not going to pay until you let me move out of the house or something like that. If I say, hey, I lost my job. I don't know what you want me to do. Now, because his name is on it, he is also responsible. The bill gets sent to a collection company where his phone is ringing, where he gets letters saying you've defaulted on a loan. He gets, a bad reputation. He gets potentially taken to court for non-payment. So all of the consequences, of the person taking on the loan, all names are just as responsible. So if a husband and wife buy a house together and they get divorced, just because one person leaves doesn't mean that they are not on the home loan. There's two names are still on the home loan, and if they want to get one of the names off, they have to, do a whole refinance, apply for a whole new loan under one name, or sell the house and get separately. But just by moving out, if your name is still attached, you are still legally responsible. So it's not easy to get someone to co-sign for you, and you should be extremely wary of co-signing for others. There are situations that exist where you can be a real benefit to someone by co-signing, but you need to be crystal clear, confident that you are going to get your money from this person, because if not, you are responsible, and you have to be okay with losing that money. You have to say, all right, I'll loan you this $10,000, but I have to also understand that I might not get it back. Right? That's not good. All right. Your interest rates. We talked about interest rates are the extra, how much are you paying on top of the amount you borrow, right? The longer you take to pay it back, the more interest you're going to pay, the more extra you're going to pay. Your interest rate could either be fixed or variable. A fixed rate loan, like the Anchor, it's fixed in place. It stays the same. You sign up for your credit card today, 6 years down the line, 10 years, 15 years down the line, you still have the same interest rate. It's a fixed rate that you and the credit card company agreed upon back in 2021. You can be confident that it's going to stay the same. If you sign up for a card that has a variable rate, it means literally it can vary. It can float. It can start really high, and the credit card person might convince you, hey, the way things are going with the economy and the market, interest rates are going to go up, but then don't worry, they're going to go down. So you're thinking, oh, I'm going to get a great deal because the interest rates are going to go down. Oh, then they went back up again. The point being, variable rates can change, and you do not get to decide if they change. The loan company is the one who changes it. So starting out, getting your first car loan, your first credit card, always make sure you're looking for a fixed rate. A low fixed rate, but a fixed rate because you want to know what you're in for. You do not want surprise changes. You do not want to be taken advantage of where, you're lured in because it's a nice low variable rate, but over the years, it just slowly gets higher and higher and higher and higher. And you agreed to it. So be very careful if it's a low rate and a fixed rate. You want to look at both of those things. Now, you might want to take that gamble. You might want to say, well, you know what? I live life on the edge. I'm going to get a variable rate and maybe it'll go down. It's probably not. It might. but it's way more likely that it's going to go up than it's going to go down. So just keep that in mind. Again, fixed rate stays the same throughout the entire time. So if it's a auto loan and it's 5 years, it's the same 3% the whole 5 years. Tends to have a little higher interest to counter the effects of rising in the future, right? I mean, if interest rates are, you know, the index, the middle ground is, let's say, 15%, but I'm promising to keep this interest rate the same forever, well, I might raise it a little bit, 16, 17, 18, 19, because I can't raise it later. So you may not be able to find the lowest fixed rate. A variable rate may be the lowest. You may be tempted in finding the lowest numbers, but check to see if they're variable rates, and really study, look at the difference between if it's 3% and 10%, that's one thing. But if it's 3% and 5%, please skip the fixed rate. Variable rates are, again, unpredictable and harder to budget for. Also, in addition to the market changes, it's your behavior as well, that with that company. If you have a credit card with, you have a credit card and you make late payments, well, they may punish you, or a consequence of that may be a raised interest rate. Or if you try to charge more than your balance, or if you completely miss a payment, you make a late payment, that could all be written into the fine print that we have the right to raise your interest rate every time. You would have to close the card to get out of that. So just make sure you're asking a ton of questions. Make sure you really understand what you're signing up for. Ask for options. Show me different options. Comparison shop. There's no one perfect loan. There might be one perfect loan for you, but please look around. Whether you're trying for a car loan, look at multiple credit unions or banks. If you're looking for a credit card, look at multiple credit cards. Compare, ask your friends, ask people who they've used that they like, who's had a bad experience. What are some things you wish you knew before you got your first loan? I wish I knew about variable. I would have stuck with fixed loans forever. With credit cards rate. First credit card was definitely variable, and it got higher and higher and higher because, they're expecting you to not really pay attention. They don't think you'll read the fine print or look at all the details on the statement, because that's on you. You have to protect your own money. You got to read your own bill and make sure that you are paying these credit card bills off in full, that you are making these loan payments in full. You're not sending, well, I know I'm supposed to pay $250 this month, but I only have $150. You need to send the whole $250. But as mentioned in the beginning, having a debt and showing that you can responsibly pay that back in a timely manner is a positive, can be a positive, right? Getting a loan so you can get a better education may help you earn a higher income for the next, 40 years of your life. Buying a house in, 1950 and selling it in 2020, I'm sure you'll be making, a few $100,000 of profit on it. So not every single debt is a bad debt, but you want to look at how it's structured. How long am I paying for it? What's the interest rate? How much am I responsible to pay monthly? What are the consequences if I don't? Because it all matters, and it stays on that report card, and it's going to stay on there for 7 years. So you want to make sure your story is telling you, or is telling everyone the most positive things, the best things about yourself. And I believe that was all. Was there any questions? Anything you wanted to have further questions about?
Let's see if we got anything on. Nothing from our followers on Facebook. We do have someone on here with us, so I will ask them if they have anything that they'd like to ask about. If not, that's okay, but if you do, you can unmute now and feel free to ask something. Nope, not seeming like it. I will say the first loans I really took out were student loans, which might be the case for a lot of you. And obviously, paying those off will help boost your credit, but you know, you do want to make sure that you're only you're trying to take back what you can afford, like Colleen said. And if you can get scholarships, it's important to look for those. It can help. I think that's it. I don't think I have any much more to add than that. So,
Yeah, especially getting early credit, your first credit. You don't want to be taken advantage of, or you don't want something to slip through the cracks. So really ask a lot of questions. I recommend going to a credit union, especially Michigan Schools and Government Credit Union. But yes, don't feel pressured into doing anything. Slow, steady, responsible is the best way to go.
okay. Well, thanks for joining us, Colleen. And everyone, tune in next week for the last part of our series. It's going to be on living on your own. We're going to give you some tips for that. So hopefully you find it informative. And thanks again. Have a good evening.
Have a great night.